Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, you've got me. I'm going to do a monologue this week about interest rates and bond prices, and even comment for a moment on Twitter, the purchase by Elon Musk, and why the share price is hovering at $48 a share instead of the $54 that Elon seems to have agreed to buy the company for. A lot of people out there, I think, are concerned about the fact that the markets have fallen off in the first quarter, and with inflation pervasive around the country, interest rates seem to be on the way up, and that tends to push bond prices down. And I think a lot of us are wondering, well, do I need to make an adjustment with the bonds in my portfolio? It seems like interest rates are probably going to continue rising. At least that's what I keep reading, and that's what the Federal Reserve says. And that's what we cover in a lot of detail here today on the podcast. There's been a lot of conversation around this. Vanguard has published a couple really good pieces on how and why these pieces all fit together in your bond portfolios, which we have linked in the show notes if you'd like to read them yourself. And I have a few comments on them about that in the show today. I hope you enjoy it.
Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services.
Alrighty, we're back with monologue on Grow Money Business. We've had some good guests on the show here last few weeks. I really enjoyed the discussion with Steve Anderson, the dude who read all of Jeff Bezos's investor letters and then could summarize them into a book. That's a pretty cool exercise, and it took him a heck of a lot of work. Next week we have a guest. I won't spill the beans too much, but he's a bigwig at Google coming on, talking about using tech solutions to drive business results and where that fits in and how you might think about doing that. And this dude's name is Chris Hood. He's the head of, I think, business innovation and strategy or something like that is his title. But he leads up this big department, and I don't want to spoil the episode because he describes what he does a lot better than I do. But his level of technological expertise is so far above mine that I struggled a little bit in the interview to keep up with him and ask the right questions. But he was a great guy to talk to, and it's been really fun interviewing some of these interesting, cool people over the last couple weeks. But this week, I wanted to do a monologue because if you've been paying attention to what's going on in the markets, there's been some funky stuff going on. It's been a little bit of a rough year so far. We have growth stocks, a lot of them starting to melt down almost after earnings, this most recent earnings season. We've got Russia continuing their trot through Ukraine and the invasion war over there. Inflation is rampant pretty much everywhere. Gas prices have started to come down just a little bit, but prices on goods and services across the board are still going up, and that's driving up interest rates by a little bit. The longer term interest rates are adjusting for the inflation levels. Mortgage rates have gone up. The Federal Reserve is talking about bumping up rates somewhat aggressively, and that's really hurt bond prices. And so what I wanted to start off with today is just talking about this concept of interest rates and bond prices, because a lot of people that we're talking to, clients, prospective clients, other people in and around the industry, are just a little bit freaked out that inflation is here. We're afraid that the Federal Reserve is going to have to raise interest rates aggressively. Our bonds are already down in value this year. What happens if rates go up further? Does that mean that I should abandon my asset allocation? Should I go to cash? Aren't bonds supposed to do well when stocks don't do so well? What's the deal with this 60-40 portfolio? Aren't those two things supposed to balance each other out? So I just wanted to talk through all of these concepts because I know that there's a lot of discomfort out there across the country and the world when you look at your portfolios that have hopefully done very, very well over the last couple of years because the market's been great, but are probably down a little bit more recently than that based on what's gone on. So in general, growth stocks have just been hammered. We talk about the FANG stocks, or we have on the podcast quite a bit over the last few years: Facebook, Amazon, Apple, Netflix, and Google. Year to date, as I sit here and record this on a Friday afternoon, Facebook is down about 40% year to date. Netflix is down somewhere between 60 and 70% year to date. They just reported their first drop in subscribers, and they estimated that they have about 100 million people using their service. I don't know if you'd call it illegally, but using somebody else's password to access their service. And so they're trying to figure out how they can crack down on multiple users using the same account, just paying for one subscription service. Even Amazon, that's done so well through the pandemic and continues to grow revenues, they're down 25% year to date. So there are a lot of growth stocks out there that are coming back to earth a little bit. These are the periods when value tends to do a little bit better, because when you buy a value stock, it's more reasonably priced in the first place. They're not typically as innovative and driving revenue and profit growth quite as quickly as these growth stocks are, but they're stable cash cows. They're not going to grow as fast or as large, but they're not going to fall as much in a recession in most circumstances too. And so that's been true year to date. Values outpaced growth by quite a bit. But since interest rates are going up, that's hurt bond prices. So let's start with that. Let's start with how bonds interact with interest rates and how that all fits together in really any portfolio, institutional or your portfolio or mine. It really doesn't matter. So the concept of duration is something that we've talked a little bit about in the past. And the best way to describe it is that duration is a bond's sensitivity to interest rates. And the best example I've come up with is, let's say that you buy a bond, you buy a $1,000 bond that pays 4% per year. Well, 4% of $1,000 is $40. And so typically the way these things are structured, you're going to get $20 deposited into your account every 6 months. The total amount of cash you get is $40, which is 4% interest. So you buy one of these bonds, you're giving $1,000 to some borrower, let's call it the US government, and let's say that it's a 5-year bond. I'm pulling these rates out of thin air. You could probably tell. That means that you give the $1,000 to the US government. In return, they're going to give you $20 deposited into your account every 6 months. And then 5 years from now, you're going to get your $1,000 back. Well, if interest rates, let's say you buy the bond for $1,000, you're getting 4%. But then a couple weeks later, interest rates fall from 4% to 3% for the federal government. And a new bond purchaser, if they give the $1,000 to the federal government, they're only going to get 3% interest, or $30 a year, or $15 every 6 months. Well, now your bond looks pretty stinking good, right? Because interest rates have gone down, and therefore the value of yours at the pre-existing higher rate looks pretty good. And so it looks pretty good. So the market value, if you were to sell your bond to somebody else before the end of that 5 years, you'd get more than $1,000, because you have this paper asset that's going to have $20 deposited into your account every 6 months. If somebody else is buying that from you, if they lend the government $1,000, they're only getting $15 deposited into their account. That's duration. When interest rates go down, bond prices go up. And when interest rates go up, bond prices go down. So same example, you buy a bond for $1,000, you're getting 4% interest. Well, if rates go from 4% to 5%, somebody else in the market who wants to buy a bond and lend to the US government, they give them $1,000. Well, they're getting $50 a year, or $25 every 6 months. You're only getting $40 a year, $20 every 6 months. So the secondary market value of your bond goes down. But remember how bonds work. You're still going to get your money back at the end of the 5 years. You just need to wait until that happens. So if you're someone who needs to use that $1,000 before the 5 years is up, well, then you might have to go to the market and sell the bond that you have to somebody else. And they're not going to be willing to pay $1,000 for it because the interest rates have just gone up. Why would they pay $1,000 for your bond when they can just lend that to the government and get 5% instead of 4%? So this is the concept of duration. It's the measure of a bond's sensitivity to interest rates. There are a couple different methods of determining duration. There are a couple of different ways that we can measure it. And the more relevant one that I'll talk about today is what's called Macaulay duration. And basically, it's a measure of time. And what it measures is the number of years it takes for you to recoup that initial investment, the weighted average amount of time that it takes to recoup. Because we're using an example of a 5-year bond. Let's stretch it out to a 30-year bond. Well, if you have a 30-year bond, you're going to have interest deposited into your account every 6 months for a long time. And at some point, you're going to have more than $1,000 deposited into your account. You might not get 100% there until you get your $1,000 back at the very end of the deal. But because you get interest deposited into your account and paid to you from the borrower throughout the term of that bond, that means that the weighted average time it takes to get your $1,000 back is less than 30 years or less than 5 years if you have a 5-year bond. And so the reason that this is relevant is because a lot of people out there are saying, well, hang on, I thought bonds were supposed to do well when my stocks went down. My stocks are down, and now I look at my bonds and they're down too. What the heck is going on? Well, inflation is clearly a thing right now. Interest rates are going up, and that's pushed down bond prices. There's never been a guarantee that stocks and bonds are always going to go in the opposite direction. Historically, they've not been totally correlated, and oftentimes when stocks go up, bonds go down, and when stocks go down, bonds go up. But there's no rule set in stone that says that that's always the way that it has to be. So this is clearly a period where that could very easily happen. I mean, we could be in a recessionary period here pretty soon, perhaps. We could be in maybe a stagflation period where we have a couple quarters of declining GDP growth at the same time that prices are going up. We could be in a deflationary period maybe a few years down the road here. We really don't know. And there's no guarantee that stocks and bonds are going to go opposite of each other. Based on how things have performed in the first 4+ months of the year, I think a lot of people are concerned about the bonds specifically in their portfolio and whether they need to make an adjustment, because they expected them to be kind of a stability and a ballast for the rest of the portfolio. And when interest rates go up, prices have gone down. So what do you do now? One of the main points I wanted to make today is that yes, if interest rates are going up, the value of your bonds are going to go down. But that is not a good reason to sell bonds and go to cash and wait out the interest rate increase period. This is exactly like timing when stocks or bonds, when the stock market is going to go up or down. Nobody can predict the direction of interest rates. This has been confirmed by a lot of academic research, just the same way that it's been confirmed we can't guess what the future of the stock market is over the next couple years or couple decades or couple months or years or quarters or whatever. But when we spread that out over longer periods of time, we don't have any guarantees of what the stock market's going to do, but we still have this big capitalistic engine throughout the world that produces corporate profits and is really a very good bet to continue to grow over time. But for bonds, a lot of people seem to be really confident that interest rates are going to continue going up, and we just don't know that. So here's how this works. We talked about Macaulay duration. It's the amount of time that it takes to recoup, the weighted average amount of time that it takes to recoup a series of cash flows in a bond. And so if you have a 30-year bond compared to a 5-year bond, you have more duration. It's going to take you longer to recoup your cash. And therefore, because you have longer duration, you're going to be more sensitive to interest rate changes. Because obviously, if you give the government $1,000, they give you 4% interest every year, you're in that deal for the next 30 years. And so if interest rates go from 4 to 5%, now you're still locked in at 4% for a longer period of time, right? If you're in a 5-year bond, you have less duration. So it's duration is, let me put it this way, a big factor in duration is the term and the maturity of the bond, right? A 5-year bond has a maturity of 5 years. A 30-year bond has a maturity of 30 years. Maturity is a big factor in duration, but it's not the only one, because over time, remember, at 4%, you get that $20 cash deposited into your account every 6 months. Well, if rates are going from 4% to 5%, you have the opportunity to reinvest that $20 at the prevailing rate at the time. And so because interest rates rise, it temporarily pushes down the value of your bond, but the values recover as you approach that time when the bonds are about to mature. And the reason I bring up Macaulay duration, the weighted average amount of time that it takes to recover the cash flows, your return that you will see depends on how long you hold it. And if you hold that bond for longer than the Macaulay duration, then you're actually better off when interest rates go up. But if you're holding a 5-year bond, the weighted average amount of time that it might take to get the cash flows back is probably somewhere around 4.5 years. If you hold it for longer than 4.5 years, rising interest rates are actually going to be better for you, because you get to reinvest all that interest in the meantime at higher prevailing rates. If you have a Macaulay duration of 4.5 years and then you sell 18 months after the interest rates have gone up, you will have lost on that investment. You'll have lost money on that investment. So this is not speculation. This is math. And for long-term investors out there, what you need to do with your bond portfolio is not reduce duration or abandon ship. You just need to make sure that your financial planning coincides with what your bond portfolio is doing. And you need to make sure that your time horizon, the amount of time you're planning on being invested in these securities, is longer than the weighted average duration or the Macaulay duration of your bond portfolio. If it's shorter than that, if you have a time horizon of 5 years and your duration is 10 years, you need to make some changes immediately. You have risks that you may or may not be able to withstand in your financial planning. But if you're a long-term investor with a 20-year time horizon and your average duration is 7 years, 10 years, rising interest rates are a good thing for you, because it will lead to more returns over that time period. Now, could you sell today and wait for the interest rates to go up and then re-enter the bond market at higher rates? Yeah, you could, and you'd be better off if you were able to time that correctly. But doing that exercise is exactly like trying to time the stock market, right? I mean, how many people have you run into that said that they knew I knew that it was obvious that interest rates were going up, or it was obvious that the market was going to sell off at the beginning of the year? Okay, you had a strong suspicion, but nobody can guess what's going to happen. It seemed likely impossible that might happen, but in order to time that right, you have to be right twice. You have to sell at the right time, and then you have to know when to re-enter the market at the right time. And it's just impossible to do consistently all the time. So for anybody out there that's considering bailing on your bonds and waiting for interest rates to go up, I think it's a bad idea if your holding period is longer than the average duration in your portfolio. If your holding period is shorter, then yes, you absolutely need to make an adjustment there. I still don't think it means trying to time the markets in terms of when interest rates are going to go up, but you need to make some kind of adjustment and at least reduce the duration of your bond portfolio. So those are a couple broad thoughts I have on the bond market in general. Now, we used a couple examples of individual bonds. By and large, today, most of you out there probably are not holding many individual bonds in your accounts, in your 401ks, your other investment accounts, IRAs, whatever. You're probably holding bond funds. A bond fund is, if we use the analogy of what a stock fund is, you can buy the 500 biggest companies by market cap in the US and recreate the S&P 500. And that's relatively easy to do. And if you buy an S&P 500 index fund, that's going to be the exact same thing, right? You can buy a bond, a bunch of individual bonds and recreate the index. You can buy a bond fund. But a stock fund is very similar to those 500 consistent or semi-consistent companies that would be included in the portfolio. When you buy a bond fund, that is more different than the underlying index than a stock fund is for its underlying index. And the reason is that the bond fund constantly has bonds that are maturing. Cash comes into the purview of the portfolio manager, and then they use that to buy another bond. So back to our example, let's say that you have a portfolio of a dozen individual bonds, and they're all, 5 to 10 years of maturity. Well, you could figure out what the average duration is of that group of bonds. You just take the weighted average of each of those positions' individual durations. It's not that hard. And you probably don't have a whole lot to do other than reinvest the cash that comes up as interest every 6 months, because if the shortest maturity that you have in your bond portfolio is 5 years, none of them are going to mature anytime soon. In a bond portfolio, there's a steady mix of new positions in and out, right? It's more diverse than that. Because if you're a portfolio manager, you have, let's say, $100 million of investor money, people who've purchased this mutual fund. Now it's your job to go buy a whole bunch of bonds. You're recreating the index. You're buying and selling what's on the list. But that list, even if it doesn't ever turn over, if there's never a bond that's, or if a bond is not ever dropped from the index because it doesn't fit the criteria of what's on the list, you're still going to drop it at some point because it's going to mature at some point. The bond matures, the portfolio gets its money back, and the bond manager then has to invest that money in the new bond that's held in that index. And so there's this constant churning in a bond portfolio, and that's a lot different than the churning that occurs in a stock mutual fund or ETF or an index fund, either an ETF or, again, a mutual fund. It really doesn't matter. The protocol is just different on the bond side is what I'm trying to say. So because of that, because most of us are probably own bond funds, either ETFs or mutual funds, as opposed to the individual securities themselves, what you want to do is look at the duration of that portfolio. It's easily available on, Morningstar or any of the places you might look up the ticker and the contents of one of these funds, but you want to take a look at the average duration in the portfolio. That's what's relevant, because there's a mix of a whole bunch of different bonds. Some of them are close to maturity. Some of them might be a little bit farther off. And that average duration and the Macaulay duration of the group is what you care about. So I'm going to say this again because it's important. This is not, my speculation of what, this tends to happen in the bond markets when, interest rates go up. This is math. This is as close to science as we get in investing. We can speculate that, historically stocks and bonds have not been terribly correlated in the past. Therefore, it's good to hold bonds in your accounts and diversify. yes, that's true. It's been true in the past. We don't know whether it's going to be true in the future, probably, but we can't really guarantee it. Duration is a lot more hard and fast and concrete. It's mathematical, it's science. That doesn't mean that we can guarantee that the value of your bonds will recover over the next, let's go back to our example, 5 years, because if you give $1,000 to the federal government, they can default on the loan. They can decide or not have the capacity to pay you back. The loan defaults, and then you don't get your money back, and the value clearly of that security, the IOU, clearly goes to zero. So it's not a guarantee, right? We can't make guarantees, but the chances of that are just so exceptionally low. And if defaults do not happen, then the math says that values will recover as you get close to maturity. That part is math. We cannot guarantee that there won't be defaults. We can guarantee that as you approach the maturity date, the value of that position will recover. And so for those of you, what do we do with our bonds? Do we sell? Do we have less duration? My response to that is we need to make sure that your holding period is longer than the duration in your portfolio. And I'm repeating myself here because it's important. If it's not, if you think you need the cash from that asset before or at an earlier date than the Macaulay duration, then you need to make an adjustment. Probably don't want to go to cash. Just reduce the duration. Don't play the game of trying to guess which way interest rates are going to go next. Just reduce the duration and stay consistent. But if your duration is shorter than your holding period, if you're 65, you don't need the money for another 10 years, and your duration is 6.5 years, hang on to what you have. Everybody's a little bit different, right? I can't give, this isn't advice. Hopefully you listen to the disclaimer at the beginning of the episode, but just wait it out because it will recover. So the other thing that I wanted to touch on here is a lot of people are wondering, well, stocks are down. Wait, bonds are down too. What about all this stuff I've heard about the 60-40 portfolio? There are a lot of people out there that are speculating that the 60-40 portfolio is dead. It's ineffective now because interest rates are so low. We have these nice two uncorrelated asset classes that have worked really well together and produced these great returns. But now stocks seem to be, on the downturn. Interest rates seem to be going up. What else could I be investing in? And is that still an appropriate balance? Yes, it is still an appropriate balance. Uncorrelated doesn't mean negatively correlated. They're not guaranteed to go opposite of one another and have bonds go up when stocks go down. They just tend to behave differently. And that difference in behavior is why it's helpful to keep them together. And that's why we create these things called asset classes in the first place. It's because different investments you might put in a portfolio have different risk return profiles. Real estate often has its own asset class because it's not the exact same thing as a stock. Alternatives, excuse me, like gold, cryptocurrency, you could classify as an alternative. They have their own asset class because they're different things. They have different substance and different risk return profiles. And anytime we can put something into a portfolio that has the potential for good returns and is not very correlated with the rest of the stuff that you hold, that improves risk-adjusted return. Bonds are slower and steadier on the growth path, but they're not as correlated to stocks. And so, yes, interest rates are low and they're going up. That's not a good reason to abandon bonds. It's a good reason to make sure that that the bonds you have fit your financial planning and are on an appropriate duration for you. Stumbling with my words here today, but other than that, I mean, it's really not a good argument to abandon ship. Okay, now the other thing I wanted to touch on is a question we've had a couple times here over the last week. So you probably heard in the news, Elon Musk has a tentative agreement to buy Twitter. question was, hey, I see that the agreement was for $54 a share. Twitter is trading at $48 a share. Why don't I just go buy shares at $48 and wait until the deal is finalized and then sell them to Elon for $54? I just made $6 for free. Wouldn't I be stupid not to do this? This is an interesting thing that I wanted to touch on, because it is this happens every time that there's a merger or an acquisition or some kind of deal. There are a lot of hedge funds out there in the world called merger arbitrage funds that speculate on the likelihood that these deals will come to finalization and close or not. And they invest money in a way that takes advantage of those kinds of discrepancies. So very short, or very briefly, the reason that it's not trading at $54.20 a share, which is what the board has agreed to sell for, is that it's not been finalized yet. All the news headlines right now are saying that Elon Musk has an agreement with the board of Twitter for the purchase. That's being misconstrued as this thing being finalized. It is not final yet. The reason that it's not final is the board can vote to approve it, but they don't have final say. The shareholders have final say. So the board has voted to recommend that the shareholders approve this deal, but they can still turn around and vote it down. They have that opportunity. So it has absolutely not been finalized. On top of that, we've talked a fair amount on the podcast about what it looks like to sell a business and what the process is. You have a buyer that puts down some earnest money. You have due diligence. You have finance. There are a lot of steps here, right? And so Musk, in a publicly traded company, the board of Twitter had to vote first whether to approve or to deny the deal, or meaning that if they approve it, they would recommend it to shareholders. If they denied it, they would not recommend it to shareholders, and it would not even go to a vote, as I understand it. So in order to make the deal more attractive, a buyer has to go out there and put the financing terms together before making the offer. And so Elon Musk did that. He got some bank financing. He has a couple equity holders arranged that might actually be banks. I don't even know. And I think he sold some shares of Tesla on top of putting cash down to arrange the financing. So he made the terms of the agreement attractive to Twitter, the board, and shareholders. He agreed to pay $6 or $7 more per share than what the company was trading at, and the board really had no choice of whether to accept it, because if the board doesn't think that they can get to that amount of dollars per share through their own activities, they have an obligation as a fiduciary to the shareholders to accept the terms of that deal. And through the guidance they got from their investment bankers, they just didn't see any way that they could do any better than the deal that Elon was offering. So they accepted the deal, but it hasn't been finalized yet. The shareholders still have to vote on it. It will go through some kind of due diligence where Elon will have the opportunity to look under the hood further and see things that he doesn't have access to without going through that process. So he will have the opportunity to back out. And a lot of conspiracy theorists out there are saying that he's just going through this whole song and dance specifically to drive up the share value so that he can exit from his position, because the board was initially willing to put him on the board a few weeks ago, and then he changed course and said that he wasn't going to do that, and then it took another turn, and he decided to purchase it because he wants to take it private and do a few other things. So there are a lot of twists and turns. But back to why it's not trading at $54 a share. It's because it's not guaranteed that this thing will go through. The shareholders could vote it down. Elon could still back out in the due diligence process. And so the more likely, the more certain that the market is that this deal will come to fruition and be finalized and executed, the higher the price will go toward approaching that $54.20 share price. So if you're someone who's absolutely certain and 100% confident that this deal will come to fruition. If you came to me and said that, I would probably say that that's total speculation. It's a guess. But if you're someone who's absolutely sure of it, then you could buy shares today for $48 each. Wait until the deal is finalized. I don't know, probably 2 to 6 months down the road, I would guess, and then collect $54.20 a share. And bingo, you've just made $6.20 in a short period of time. But there's always the risk that it goes south. And if the deal is off, then the market will evaluate Twitter on its own fundamentals, its own profitability, without any outside investing help. And I would be very surprised if the price did not drop if that ever happened. So you're basically betting that the deal will be finalized and come to fruition in the future. And like I said, there are a lot of professional investors, really, really smart, experienced professional investors who have teams at hedge funds that focus on this kind of stuff. There are all sorts of merger arb opportunities like this. Some of them will, if for example, it wasn't Elon Musk, it was another corporation, maybe let's say Facebook was going to buy Twitter. Well, generally the buyer sees their stock price fall, and the seller sees the stock price rise. And so if you're betting on the completion of the deal, you might want to sell shares of Facebook short, and shares of Twitter you'd turn around and buy to close the gap between the two. That's not the typical long-term portfolio that we talk about here on the show that's more applicable to everybody listening probably, but it is something that happens in the investment markets, and a lot of institutional investors like to invest in that kind of stuff because you don't have as much market exposure. If the stock market crashes, the value of your merger arb positions is not going to fall by as much, and oftentimes these funds totally hedge their market exposure in the first place. Okay, so that's it for today. I hope this was helpful. Again, I'm going to repeat it for a third time because this is important. If you're someone who's concerned about the bond positions in your portfolio, evaluate your holding period. How long do you expect to use or to stay in these investments, and compare it to the Macaulay duration for your bonds. If you expect to stay in the positions for 10 years and your duration is 6.5 years, it's probably better not to do anything, because the value of the bonds will recover as you approach that 6.5-year duration. If you need to pull the cash out in 3 years because you're about to retire or you're about to buy a house or do something else, and the duration of your bonds is 6.5 years, then you've got a problem. You probably need to shorten up your duration if you're concerned about interest rates still going up. All right, that's it for today. Quick request to head over to Apple iTunes, Apple Podcasts, or Spotify, or wherever you consume your podcasts, and give us a quick 5-star rating. We've had some really good reviews here over the last couple months, but I'd like to keep that going, and would really appreciate it if you all would give us 5 stars and leave a positive review, because that does help us show up in a few more places. All right, thanks for listening. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.